Q1 GDP growth numbers will be out, as I said, about 1 hour from now, which is 5:30 p.m. Higher government capital expenditure, a pickup in service sector and a favourable base are likely to have pushed up the growth of India's real GDP in April-June quarter, which is the first quarter of this financial year, with economists projecting a growth rate of 7.7 to 8.5%. That, of course, is the range. Now, country's growth rate is, however, expected to be moderate in coming quarters of this financial year, given that there will be impact of El Nino on monsoon and sluggish exports. That, of course, will weigh in on the growth story. But as far as numbers for the first quarter is concerned, positive expectation there. Joining us at this point is Sujan Hajra, who is the Executive Director and Chief Economist at Anand Rathi. Sujan, thanks very much, sir, for taking time out. I want to first begin by asking, what are your expectations as far as the Q1 growth is concerned?
Our sense is that the ballpark estimate is 8%. So roughly we are at the middle of the consensus. So 8% is what we are looking for the quarter. But for the full year, we are seeing a number which is significantly lower. We are looking for the full year closer to 6.2% GDP growth for the financial year 24. That is FY 24, year ending March 24.
All right. So an expectation of 8%. 8%, of course, falls within the range of what everybody, all experts are projecting out there. What, according to you, will work? What are going to be the laggards?
Obviously, the base effect is something which is going to help. But beyond that, we are seeing very significant traction in the services sector. For example, if you look at the passenger traffic, whether railway or whether air, these numbers are pretty strong. In other areas of services, whether you are talking about entertainment, whether you are talking about healthcare, whether you are talking about other consumer services, we think there will be a significant traction there. Manufacturing, it will be more of a so-so kind of a sector. This quarter is not particularly important so far as the agriculture is concerned, because the main crop Kharif comes in the quarter ending December and part of it in quarter ending March. So this is relatively a lean period for agriculture. So nothing much to read about agriculture. Within industry, the infra-related areas are doing well, but the core manufacturing sector, there is not much traction. So on the services side, we expect a significant traction, sort of a intermediate kind of a thing from the industry side. And agriculture, we are not penciling in a very high expectation.
All right, not much and higher expectation as far as agriculture is concerned, but I suppose better private consumption, services, export, manufacturing, easing input cost pressure. In fact, we discussed here, all companies that reported their quarterly earnings and significant margins that they were able to save, essentially hinting at the fact that perhaps input cost has reduced in the last quarter, the quarter gone by. That, of course, will weigh in positively on the quarterly growth. But, some more numbers that are coming in. And as we speak, fiscal deficit numbers for the quarter gone by are out. India's April-July fiscal deficit stands at about 6 lakh crore, 33.9% of financial year 24 target. How good or bad are these numbers?
So my sense is that I haven't seen the number for this particular month, but generally, if you look at the corporate tax, is the part where the numbers are not panning out very well. All other taxes number, whether GST or whether the other taxes are concerned, though personal income tax, those are doing reasonably well. But as you said that while the corporate profitability has not shrunk, the corporate profitability growth certainly has slowed down as compared to the same quarter last year. Say, for example, the quarter ending June for Nifty 50 companies, the earnings growth has been somewhere close to 6%, as opposed to a 30% plus number for the same quarter last year. So consequently, that's impacting the corporate tax collection. But going into the year, we expect this number to play out better. So therefore, what we think is that a lot of government expenditure is front-loaded, whereas the revenue is back-loaded. Consequently, the fiscal deficit number might look slightly more stretched during the first half of the year, but we think that will pan out better in the second half of the year.
All right, so fiscal deficit numbers looking stretched at the moment. As far as going into, the second quarter of this year is concerned, the ongoing quarter, the expectation are slightly muted there.
Yeah, the second quarter number can be slightly muted once again, partly because of the base effect. Also, in the recent past, we have seen that the impact of high food prices, the high interest rate, all these things are weighing down on the numbers. Also, if you look at the foreign trade, particularly goods trade, the numbers for the second quarter may not be particularly good, though in terms of services exports we are doing pretty well. But the goods trade, though the trade deficit is coming down, but export performance is not particularly well. So those are kind of things which will be there in the second quarter as well.
All right, but the government feels that export numbers are going to go up. Are you looking at any green shoots emerging at the moment?
See, as I said, the biggest positive so far as the exports are concerned are coming from the services sector.
Mhm.
Not so far,
How
not
about
so far,
merchandise export? Do you see that picking up?
the worst may be over, but given that the kind of global scenario which is prevailing, I don't see that the growth will be significantly high for merchandise exports. For example, for sectors such as chemical, for sectors such as gems and jewelry, the realizations are becoming increasingly big problem, and these are big exports. But yes, in certain areas, maybe in the context of automobile, maybe context of some of the consumer goods, the numbers might start looking better.
All right, I want to also talk about inflation. Inflation remains an untamed beast as far as the ongoing month of August is concerned. Some pressure expected to ease in the month of September, but everything in the realm of speculation, contradictory reports coming out there. Inflation is going to be very, very crucial to watch out for.
True. So what you have seen, if you look at between June and July, the monthly increase in inflation on an annualized basis for food products has been about 70%. For fuel energy, the increase has been almost 30%. So obviously, a significant amount of momentum is getting built up so far, what we call as the non-core part of the inflation. But interestingly, the core inflation, which is excluding food and fuel, that component is actually coming off pretty significantly, and this is happening both for goods and services. So while the overall headline number, overall food inflation, these are matter of concern, but there is also some level of silver lining so far as the inflation is concerned. And if you look at the RBI's monetary policy during the month, RBI clearly indicated its expectation is that this inflation is transitory. So at this moment of time, we'll hold on to it and we'll think that this inflation is transitory. And so therefore, while we are certainly watching out, certainly we are keeping our fingers crossed, but we don't think, at least as of now, it's a very big concern for India.
All right, not a very big concern, but as you mentioned, I think vegetable inflation, pulses inflation, that's going to remain a cause of worry in the month of September. The rainfall pattern is uneven. I think that's what everybody has reported, that we are sure on. The north of India has gotten more rainfall than expected, south of India under at least by 30%. So the weather pattern, of course, uneven throughout the country, and all of that, of course, is going to weigh in heavily as far as headline inflation is concerned.
True, with close to 50% of your retail basket being linked directly or indirectly to food, obviously our sensitivity to food inflation is very high. And say we have seen last month products like tomato is showing a year-over-year inflation of 200%. There are certain other products like garlic or jeera which are showing inflation of in excess of 100%. So clearly these are the areas of concern. Now, traditionally, the areas of concern which remains for India in terms of food products are pulses and oilseeds. Fortunately, those inflation has not gone up too much, but we are again seeing in the food grain the inflation is going up not only for wheat, but more recently even for rice. This inflation is going up, and these have heavy weightage in the retail basket. So therefore, as I said, there are plenty of reasons for concern. But it looks like this is more of a transitory. The government also has taken quite a few supply-sided measures. For example, import of tomato, or for example, the restrictions of export of wheat and rice. So government is taking supply-sided measures. RBI has already taken demand-sided measures by increasing the policy rate, and vegetable inflation at any case is extremely volatile. And so, given all these things, as I said, while we keep our fingers crossed, but our sense is that this is more transitory than permanent.
So as you said, the core inflation has continued to ease. So will it be safe to say that if we don't see a spike in core inflation, RBI may not hike interest rates?
See, if you look at RBI's stance, RBI looks at inflation as a monetary phenomenon. So for RBI, it really doesn't matter so much whether it's a supply-sided or demand-sided, whether it's coming from core or coming from non-core. That is why the target for inflation for Monetary Policy Committee is the headline inflation rather than core inflation. So therefore, so long inflation remains high, that there are reasons that RBI will be worried. But having said that, RBI's own assessment has been that this is more of a transitory. So if it's transitory, obviously RBI won't be, or there won't be any major reaction from RBI. But having said that, if the inflation number remains high, retail inflation number for the month of August remains high, and there is indication even for September this number is going to be high, then I don't think RBI will have much choice but to do at least some optical measures towards controlling inflationary expectation. So I think muted core inflation is a silver lining, but RBI won't be putting too much of weightage to that factor alone. RBI has to look into the overall inflationary situation, and more importantly, the situation in terms of inflationary expectation. So therefore, if there is pressure on inflation, RBI hands will be tied. And RBI has to go for some level of at least token tightening of policy in that situation.
But then if there is a revision of policy rates on the upside, will that not stifle the demand that at least that the recovery in demand that we are seeing currently?
See, the point is that there are various channels of transmission of monetary policy, and see RBI it's quite well understood that there is a sacrifice between growth and inflation in the short term through monetary policy action. What RBI's objective, what is the objective of every central bank of the world, is to basically stabilize the medium term inflation. So for that, if there has to be some level of growth sacrifice in the short term, because RBI doesn't want a boom bust kind of a GDP. RBI wants a sustained level of GDP growth. So for that, if some level of growth has to be sacrificed in the short term, I don't think RBI will shy away from that. In the past also, RBI has taken similar measures. If in the future, if that is required, I don't think will shy away from taking such measures. So therefore, I think if the inflation goes up, RBI does not have much choice but to go for inflation, given the fact that if the economy is growing at 8%, and even for the whole year, if the economy grows by 6.2%, we can't say the growth is very bad, particularly under this global milieu. So I don't think it's a crisis situation so far as growth is concerned. So RBI has to focus on inflation control.
All right, and not just RBI, in fact, government also hoping that it eases the burden on people, given how expensive it has become to cook, how expensive it has become to, fetch vegetables, buy essential items for that matter. Reports also coming in, Krishna, that the fact that LPG cylinder rates have been revised downward, cut by about 200 rupees, is also somewhere going to impact inflation and ease pressure on people.
That's something I want to ask Sujan as well. Sujan, at the end of the day, controlling food inflation is literally not in any kind of policymakers' hands at the way the situation is right now. When you have a crop that hasn't yielded enough the way we want it to, then there's a problem. There is clearly supply side constraints that is leading to food inflation in the country, and that really doesn't become upon neither the RBI nor the finance ministry to come up with the policies to deal with that. The point being, who deals with that?
Yeah, please go ahead. See, obviously, supply-side inflation is very difficult to control either by the government or by the RBI. and still government has some levers in terms of export ban or taking recourse to import or giving some level of cross subsidization, as in the case of LPG cylinders. RBI doesn't. RBI has only one policy, which is a very blunt measure. RBI can either increase or keep the interest rate unchanged or reduce the interest rate. So in that sense, for RBI, fine tuning in response to different sources of inflation is extremely difficult. RBI doesn't do selective credit control, which RBI used to do earlier. So therefore, if it's but having said that, it really doesn't matter whether it's a supply-sided or demand-sided inflation, because it ultimately gets transmitted through wage price spiral. So it's very important for the central bank to address inflation irrespective of whether it's supply-sided or demand-sided. It's not that you are trying to reduce the supply-sided inflation. What you are trying to do is to stop the spillover of the supply-sided inflation into demand through wage price spiral.
Right.
So that's why the causality is very different.
Right, Sujan, at this stage, the only thing I have to ask is that we're all awaiting the GDP numbers. Now, the question always is when inflation is high, you want to step in with policies, hike interest rates, then the direct impact of that is usually seen on GDP numbers,
on people and growth
and
numbers. Consumption.
Yeah, so you have a situation right now where we are hoping for better and better GDP numbers with every passing quarter. At the same time, you want to, we are in this rate hike pause moment, so to speak. The RBI has paused on its rate hike cycle with a chance that there could be another rate hike coming if there's the US Fed decides to hike it further than what people expect it to be. And now you have inflation to deal with. Now, talk to us from just a pure interest rate perspective. And as we are at the threshold of receiving new GDP numbers, from your own expectations, from that perspective, how are these two going to go going forward?
So RBI has the twin objective, both to have policies supportive to promote growth and also to control inflation. So it's a catch-22 situation in some sense, that if you, but having said that, as I said, in terms of long-term growth, India's current growth is not significantly lower than the long-term growth. In terms of current inflation, it's significantly higher than the long-term inflation. So I think the choice is very clear. The choice is very clear for RBI. If you have high growth, high inflation, the typical monetary policy recommendation is to go for rate hike or go for liquidity withdrawal. But having said that, we have already seen very significant amount of monetary tightening, not only in RBI but also globally, and so therefore there will be some delayed impact of that on growth. So that also cannot be totally ignored. But my sense is that RBI would wait out for a couple of more data points before taking a decision to hike rate. So RBI's as of now, the stance should be wait and watch.
All right, and as we wait and watch, just about under an hour before the numbers come out, and before I let you go, we're also showing in fact numbers as far as Q1 GDP for various other countries is concerned. So China, UK, Japan, Germany, US. China's GDP grew at 6.3%. UK's GDP increased by merely 0.4%. Japan by 6%. Germany contracted by 0.2%, and US grew by 2.1%. Different story playing out in other developed markets, developed economies. China, of course, leading the pack there, but it's a different story with China. We can never trust the numbers.
With the lowest of expectations from India, India would still be beating China, at least for the latest set of numbers are concerned, which is, fact of the matter is that over and above our discussion on inflation versus growth, I think, those numbers, Sujan, if I were to ask you one last final take, you and I both know at this stage that the numbers that are going to come out are going to beat every other country on that list of GDP numbers. What does that mean?
See, we actively track about 100 countries in terms of growth. And India obviously is the fastest growing major economy in the world, though there are some minor countries which are growing faster than India. But as you rightly said, among the major economies, and if you look at, this is not just for this quarter, or this is not just for this year. If you look at the IMF forecast till 2028, every single year from 2023 to 2028, India is going to be the fastest growing major economy of the world. So that basically means we are on the moon. India is the fastest growing major economy in terms of macro performance. Most of the areas are doing well in terms of corporate performance. Our corporate growth rates are generally significantly better than the most of the peers. There is a lot of domestic money getting into the Indian equity market. There is foreign money again which has come back to the Indian equity market. The market valuations are slightly stretched, but still not extremely overstretched. So generally, very good news for the economy, good
Right.
news for the market.
All right, India remains fastest growing developing economy, major economy, not just that, going to be a $5 trillion economy very, very soon on its path, leading not just emerging markets, but also leading various developing markets all out there. But I think those numbers will be interesting to watch out for. We'll get you those numbers as and when they come out. But for now, I think we'll have to wrap up this bulletin. Sujan Hajra, thanks very much, sir, for taking time out for joining us. Appreciate your inputs here on News9. But with that, it's a wrap on this bulletin. Thanks very much for watching.